focus of today's class will be on introduction, or what we term as overview. Now, what we're going to discuss under the overview include the impact or the importance of having capital market forecasts or in our analysis. So we can introduce and say that combining capital market expectations, combining capital market expectations with the client's objectives and constraints, with the client's objectives and constraints leads to the portfolio strategic asset allocation. Leads to the portfolio strategic asset allocation. Strategic asset allocation leads to portfolio strategic asset allocation. We can continue and say the quality of tools and techniques, the quality of tools and techniques are useful in forming capital market expectations for return, risk and correlations by asset classes. Let's stop there, guys, and discuss what we have written. We're saying that under the overview of capital market forecasts, we are saying combining capital market expectations, which we're terming as capital market forecasts, with the client's objectives. So capital market expectations is key, with the client's objectives and constraints, right over there, leads to portfolio strategic asset allocation. So allocations can actually be done based on mapping up the capital market focus on one side and clients' objectives and constraints on the other side over here. So leads to portfolio strategic asset allocation right there. The quality of tools and the techniques are useful in forming capital market expectations for return. The key word there is return, risk, and correlations by asset classes. Right there. So we can build on that discussion and say that we have the capital market expectations on this side over here. Capital market expectations, CMEs. And on this other side over here, we have the investors' objectives and constraints. So these need to be mapped up together. These are exogenous, external factors that impact on the achievement of the objectives and constraints for the client. And so we are saying that in terms of the application framework or the overview, we can say that capital market expectation plays a very crucial role in defining or in determining the investors' objectives and constraints. So we build on that and say that asset classes. So we can say that as well, the detection of security mispricings. Security mispricings is crucial to the investment manager, manager, for execution to be effective in achieving returns. To be effective in achieving returns. We continue and say that formulating capital market expectations, formulating what we can term as CMEs, or capital market expectations, is referred to as better research. In contrast, we say alpha research, put a capital A, alpha research seeks to earn excess returns by identifying the difference between the expected return and required. So we are saying that to get or to generate alpha, we're saying just the expected return minus the required return, and you're able to get the excess return right there. So we need to explain why it is called better research, because you're saying it is related to systematic risk. Better research is related to systematic risk. So we say that, or mention that. Better research is related to systematic risk. Hence the name beta. Like that. So we just recap what we've just discussed here. We are saying as well the detection of security mispricings is crucial to the investment manager for execution to be effective. Right there. Put a full stop over there. And we continue saying, not a full stop right there, pardon me, effective in achieving returns. Okay. Formulating capital market expectations, CMEs, is referred to as better research, because better research tries to seek or tries to manage systematic risk exposures. In contrast, alpha research seeks to earn excess returns by identifying the difference between the expected return and the required return.